There's a pretty wide range of what could be considered closing costs.
What would be some tips you would give buyers going forward? Hey, this is Jeremiah Dow with the Symphony Group with Keller Williams Little East. I'm here with John Rickert, home loan lender with Southwest Funding, and he's going to break down mortgages for us today. Really simplified, especially for those new to the home market who want to buy a home but just are intimidated by the mortgage loan process. John, thanks for being here.
Hey, thank you for having me.
As a realtor, I'm always telling people, hey, look, we got to get pre-approved. We got to know how much we can afford. I think the word pre-approved can be a little deceiving at times. They don't really know what it means. Can you break down what the word pre-approval means for us?
Pre-approval is just where someone like myself has gathered up the person's income, their credit history, and their down payment capability, put it into our approval software, and ran an approval. And it'll basically come back and say whether or not this person's qualified to buy a home, and if they are, under what conditions, such as provide those pay stubs that I just gathered from them or something along those lines.
So they've submitted to you how much they make, how much they owe, and you're going to tell them, one, if they can buy a home, if they're in a good position to, and two, how much they can afford.
That's correct. I'll typically issue a pre-approval for a maximum amount unless they tell me otherwise. And they can always buy less. So if I go pre-approve you for a $300,000 home and you want to buy a $200,000 home, that's totally okay.
And if their pre-approval process, are you able to tell them a general idea of what their payment would look like going out the gate?
Pretty close. I don't know some of the small figures like taxes and insurance, but the actual mortgage payment itself, I can get pretty accurate on.
Before we go further in the mortgage process, I want to ask you, what are some things that can make a buyer stronger in getting a good pre-approval?
Credit's probably the most obvious one. The higher the credit score, the better off we're going to be. And if people call me early in the process, I can typically give them some amount of guidance to get the score as high as possible for the time of the application.
So early in the process. So this is before they found a home.
Ideally, yes. The sooner that I can get to the person, the more time I have with them, the more likely I'll be able to improve them.
Some people also are afraid that if they have too much debt, they owe too much on too many things. That'll keep them from buying a home. Can you explain a thing called debt to income ratio?
Sure. Debt to income ratio is how much you make versus how much you spend. Most loan programs prefer somewhere around 50% of your debt to income to be dedicated towards your debt or less. That means your house payment plus your other credit debts such as car, credit cards, boats, anything along those lines are less than 50% of your total gross income. Now, that's a little high personally, but that's usually as high as the approvals will go.
So if you made $3,000 a month,
the lenders aren't going to want you to have more than $1,500 a month between your house, car, credit cards, and everything
going
else.
Towards debts.
And that's a rough rule of thumb. It's not a guarantee.
But it gives people an idea of how they're going to be looked at by banks and lenders.
Exactly.
Okay.
And the lower the debt to income ratio, the better. Statistically, 25% is the most prime, but between 25 and 50 is generally acceptable.
My buyers and I go out, we find this beautiful home for $300,000 and we're ready to get started and we have to apply for the loan. We got the contract accepted. They come back to you and they say, John, we have to apply for this loan now. So what's the next step in the process?
They've kind of already applied the way I do it. I already have all their documents and I already have the approval and their application. So now that I have a contract, as long as they give me permission, I just have to submit all of that to a lender as an application. It takes me about 5 minutes to package it all up and send it in. From the time that happens, the lender will accept it and they've completed their application.
During the process, the term underwriters gets mentioned.
Sure.
And people are always kind of wary about what does an underwriter, what does it even mean? Can you explain and simplify what an underwriter actually does?
So if you think about me as being on the client's team and helping them get approved, find all the documents and all that fun stuff, the underwriter is who represents the lender. Whenever I take that approval and send it in, there's got to be somebody on the lender's side that reviews everything I sent in and makes sure it checks every box. They're a lot more granular than me and a lot more specific than me on the initial phase, but they basically work on behalf of the lender to make sure that everything I put in that approval is backed up, factual, accurate, and just there's no typos or mistakes or anything along those lines.
The underwriter is there to verify that all the information that my buyers turned into you is actually factual and correct. They can be loaned this money and be trusted with this loan amount.
That's correct.
So now they've gotten through that process and the underwriters give them the stamp of approval, ready to go to closing. One thing that comes up is closing cost. People often ask, well, what are closing costs? How much do they cost? And a lot of people think that closing costs is just how much it costs to borrow the money. So can you maybe simplify and explain what closing costs actually are and what it entails?
Sure. Depending on who you ask, you're probably going to get a different answer because there's a pretty wide range of what could be considered closing costs. Generally, they're broken down into a couple of categories. The biggest and main one is the lender fees, and that's anything the lender charges you. It could be processing, underwriting, or something incidental, but anything that comes from the lender for doing the loan is the lender fee. Then you have third-party fees. These include things like the appraisal on your home, which is whatever the appraiser charges to tell us how much your home is worth. You'll have your title, which is who transfers the property from the old owner to the new owner and then conducts the settlement for us. That's typically a lawyer, and we have to pay them. You also have taxes and insurance. The insurance is based on whoever you select to be your insurance carrier, but we have to pay them a year of your insurance up front to start the policy. And then we've got taxes. Typically, we have to round out to the end of the year so that we can pay your taxes on time next year. And on some select loans, there's also an additional government fee that you have to pay for government-backed loans.
On a $300,000 house, which is what we started with, that was our scenario, and we have to pay taxes on that right out the gate on closing costs. What would people expect to pay?
In Kentucky, we typically pay about 1% per year, so a $300,000 house would be about $3,000 per year. And if we needed 3 months to start the escrow account, which is pretty normal, you'd pay a $900 deposit plus whatever it takes to round out the year.
So you mentioned escrow.
Yeah.
Okay, and a lot of people don't know what escrow is, especially just starting out. Can you explain what the term escrow means?
Taxes and insurance are ongoing fees that are part of your mortgage that you're going to have to pay every single year that you own the house. And the lender is nice enough to take those annual payments, chop them up by 12, and put them on top of your mortgage payment so you don't have to manage it. They just manage it for you.
Instead of them getting a tax bill for their home and a bill for their insurance at the end of the year that they have to come up with this large amount of money, they are paying it every month to the mortgage company.
You got it.
And the mortgage company is collecting it and paying that bill for them.
That's correct. Now,
And that is escrow.
Yep, and they're still going to get a copy of the bill.
Right.
It'll just be paid by somebody else. Believe it or not, that's a question I get at least 5 or 6 times every tax season because they see the bill and they thought it was covered by their mortgage, and it is, but they still send the natural bill to the house, and it's still whatever insurance company you pick. It's not picked by the lender.
So it's good to escrow because you won't get surprised by a large payment.
Everybody has their own preference, but I agree with that methodology. I prefer the simplicity of not having large payments once a year, and I like the fact that I can just write it with my mortgage. It's just less bills to handle.
Going forward, now that we've really simplified the mortgage process, what would be some tips you would give buyers going forward?
Honestly, I really wish people would call me earlier rather than later. The amount of people that call me when they find a house and I find out if I'd had their attention a month sooner, I could have given them a much better deal because we could have designed the loan better, is too high. So if you can, reach out to me or whoever your mortgage lender is going to be as early as possible to give us as much time to coach you into the best position as possible to qualify for the best loan.
Yeah, I think John's right. You always want to get started early. Ask all the questions, get all the education you can early. John, thanks for being here today.
Anytime.
Appreciate it. Any other questions, you can email John or myself. Thanks.